Hi, everybody. Welcome to the second segment, episode 278, Sold with Updike Pugh. I have Jeremy Radcliffe with SWBC Mortgage here with us today, and there's so much talk about interest rates.
Yes,
and
so all over the map. Yep.
Tell us the story. Bring your data. Show us what's going on.
Yeah. So we were talking about this the other day. Rates are starting to come down a little bit, which is really encouraging. And I think it's got people talking. They're saying, "Hey, is the Fed has actually lowered rates. They haven't done that change in interest rates yet. But what has happened is I think there's an expectation that might be happening. There's some leading indicators, particularly you might have heard about the Consumer Price Index, which is the big measurement for inflation. Back in June, it was the first time we'd seen since the pandemic inflation kind of get down to that 3% number that is closer to the target of the 2%. Mm-hmm. That's good news because inflation is really the driver. It's kind of the enemy to interest rates. Mm-hmm. What happens is as inflation goes up, interest rates have to offset to make up that. Just the dollar doesn't go as far, so lenders have to charge more on interest rates. So this kind of gives you a little bit of a picture of what's happened on that CPI data. This is 12 months, over the last 12 months, and you can see in June of last month we got back down to 3%. What's crazy is, back during the pandemic we were up almost 9%.
Isn't it nuts?
Yeah.
Things were going up so quickly.
I think that's been a lot of what the Fed's been waiting for and looking for is, are we going to see a drop in that inflation information? Hopeful for that, and hopefully that will continue to move in that direction. If we do see that, I would expect, Jeff, to see interest rates come down more, the bond market pricing that in, but and then also potentially the Fed actually doing a rate reduction, which there's talks of that happening maybe once or twice, 2024. But across the board, expectation in the mortgage market is that we're going to see some rate cuts. We're all very excited to see that as well. So,
one of the how the mortgage rates, of course, I'm just saying,
sure,
people in general, I think sometimes think that Fed rate is directly tied to mortgage rates, and it's really, mortgage rates are really the combination of so many different things. And like you talked about rates coming down, and like on the next slide,
on the trends.
On the trends. It's funny you bring this up because I was looking at almost the identical slide this morning.
Right.
Because if we talk about rates coming down. Well, in the first segment we talked about them being 6.78 on conventional. They were over 7.5 back in April.
Correct. Yeah.
So rates have come down.
They have come down. We're not quite at a point drop in rates, but there's definitely been, and a lot of that's been driven by that inflation.
And there's no change in the Fed rate in that term.
No. And what's interesting is that's the bond market kind of building in the expectation. There's a lot more. When the Fed talks about dropping interest rates, it's a specific rate. It's called the overnight funds rate. And that's the rate that banks will lend to one another. Mm-hmm. And so it's a bit of a misnomer that if the Fed were to drop rates by a half a point, then that's going to be an automatic change in interest rates of that same. Sometimes it could be more, sometimes it could be a little bit less. But to your point, and that this slide's showing a little bit of I like this. This is coming from Optimal Blue again. It's a great resource if you're just trying to get a sense of what's going on with trends with rates. You can see how we were pushing up over 7.5% back in April. Now we're kind of closer to that mid to high sixes right now, which is great. I think everybody's excited about this. I think the next chart will show you. I like to jump on to FRED, which stands for the Federal Reserve Economic Data. I like this because there's a lot of different information you can get from FRED. This is just again showing you the picture of what's happening with rates and trends, and then again pushing up back in. So that we saw rates get as high as we'd seen back in the fall of last year. Mm-hmm. That's where you can see it almost pushing 8%. That's when people were kind of like, wait, what's going on? So in that sense, we have dropped down a point since not quite a year. So I think everyone's encouraged by that. A lot of what we do, though, and I don't know if people are aware of this, the big driver around mortgage rates is this. It's an investment vehicle called a mortgage-backed security, which is imagined as a bond that people can invest in. That EMBS pricing comes out to us every day. I don't know, Zach, if you have that next slide, but it basically shows from a technical analysis you can kind of see this candlestick chart showing MBS pricing. The interesting thing about it, there's an inverse relationship between what happens on this pricing and interest rates. So as that pricing drops, interest rates have to increase to offset the difference. So we've seen that pricing jump up over the last 90 days. We kind of tanked a couple of months back, but since then we've had some pretty significant improvement on that. So that's been very helpful from an interest rate standpoint. Hopefully we'll continue to see that MBS pricing improve. I thought I'd put together just kind of a quick scenario. What does this look like in terms of my monthly payments? So I just chose a few different options. Looking at the conventional loan, assuming you were at a $950 purchase price doing 20% down, showing interest rate at 6.625 with an APR of 6.673. Payment on that, this is just principal and interest, so you're looking around a $48.66 monthly payment. You can ignore the cash to close on that. Similar, we were just talking about jumbo loans. There's really not a big delta between what's happening on conventional loans and jumbo loans. And so on a 1.2 million, assuming you were to do 20% down, keeping it above that conforming loan limit at 960, similar rate right at 6.75. I think what I got excited about though was moving over to FHA, how we were able to drop back into the fives. And we were talking a little bit before this, how you could pair that now with a temporary buy down, potentially get into the threes for the first year, which would be probably pretty attractive for people.
Especially if you're somebody that's maybe this is your first or second year of your career, and you know that in the next 2 or 3 years you're going to see a pretty dramatic increase in income. It's a way to lock in the value or the price of the home today, lock in an interest rate for long term, but they still have the flexibility to refinance if rates did come down, right?
Absolutely, and the thing I do like about that temporary buy down is it's a subsidy paid by the seller, so it's different than like a permanent discount point. If once you go to refinance, you don't lose that subsidy. It gets applied back towards your principal, so the money's not lost.
Interesting.
So if you were to refinance in 12 months or 6 months, you still there's a schedule of how that money's paid out. If there's still a balance on that subsidy, then it comes back to you, which is great. I like that a lot. So I just wanted to kind of jump on and show you guys a little bit of where trends are going. I'm encouraged. I think a lot of people are, what I would encourage people is to say there is an expectation that the Fed's going to drop rates. I would also say don't wait until that happens if you're trying to get into a house, because everyone else is wanting to do the same thing. And it would be similar to back in, it was kind of the inverse. Back in the spring of 2022, there was a lot of concern about the Fed. There was talk of the Fed raising rates, and that's when we saw prices get really silly, where everyone was trying to jump in.
Everybody was waiving appraisals and waiving inspections, and that was a lot of my friends have said, "Oh my God, that must have just been such a great time for you." And I have to tell them it's not really that great of a time, whether you're a buyer's agent or a listing agent, because if you're a buyer's agent, you might have to write some 10 or 12 offers for somebody before you get one accepted. If you're the listing agent, if you're getting 25 offers on that house, you've got to analyze each of those and help that seller to figure out which one's the right one.
That's exactly what's going to happen.
Crazy.
That's what's going to happen if I think there is an expectation of, I'll just wait. That's as I talk to clients or different friends, be like, well, when are rates going to come down? We'll move at that point. And I'm like, okay, well, you and everyone else. So
get ready.
Basic laws of supply and demand would say, and to that point, I think what would be helpful for your listeners to know is that there's nothing that would preclude you from refinancing. Let's say you were to close now, and if rates were to come down 6 months, you can absolutely refinance out of that. So I say jump while you can. If you found the right house with you guys, I say take an opportunity right now. So
he's the professional, everybody. So
thanks.
Jeremy, thanks for coming in today.
Yes, thanks for having me. It's
really
always great to be
you.
with you guys. Yeah.
So if there's any other information you need, Jeremy's info is going to be up on the screen in a minute. Just reach out to him. Jeremy and Weston and I have worked together for, what has it been, 14 years now? And
it's a long time.
Jeremy will tell you the truth, period. That is the thing we like about him. Whether it's good news or bad news, he's going to tell you the truth.
We have to sleep at night, right?
Yeah, exactly right.
We have to sleep at night.
So thanks for joining us today. And just remember, we want to be your realtors for life.
Thanks.
When you're ready to talk real estate, you can reach us online, by phone, or by text at 214-377-2223.
And remember, we want to be realtors for life.